The most dangerous moment in a financial crisis is not when the panic hits the streets, but the silent period immediately preceding it, the moment when the data has already confirmed the collapse, but the public perception has not yet caught up to the reality. Imagine standing on a beach, watching the tide recede unnaturally fast, miles out to sea. The tourists are confused, perhaps even excited by the exposed seabed, taking photos of the stranded fish. But the locals, the ones who understand the history of the ocean, are already running for the high ground because they know that the water isn't just disappearing, it is gathering strength for a return that will wash away everything in its path. This is exactly where we stand in the global economy right now. We are watching the liquidity drain from the system, we are watching the trust in sovereign debt evaporate, and we are watching the geopolitical order fracture, yet the stock market is still taking selfies on the beach. The water is pulling back, and the tsunami is a monetary reset that will redefine wealth for the next century. The question is no longer if it will happen, but whether you will be standing on the high ground when the wave breaks. Welcome back to Growth Grid, the channel where we refuse to accept the sanitized narrative of the mainstream financial media. We dig deep into the mechanics of the machine to show you not just what is happening, but why it is happening, and most importantly, what you can do to survive it. Today we are dissecting a critical analysis featuring market expert Innecco, breaking down the undeniable signals that the global fiat system has entered its terminal phase. We are going to explore the terrifying divergence between the paper markets and the physical reality, the suicide of Western energy policy, and the concept of the boiling frog reset that is already underway. This is not speculation. This is a forensic accounting of a crime scene where the victim is the purchasing power of your currency. Most people believe that markets are driven by greed, by the desire to make more, to grow faster, to consume more. But the most violent, explosive moves in financial history are never driven by greed. They are driven by fear. And right now, the smart money, the central banks, and the sovereign wealth funds are afraid. To understand why this shift is so significant, we have to look at the psychology of the current gold and silver rally. When a stock goes up because of greed, it is a fragile ascent. It is built on the hope of future earnings, on the hype of a new technology, or on the easy credit of low interest rates. But when an asset class moves because of fear, the dynamic is completely different. As Innecco points out, we are entering a phase where the rise in precious metals is reflecting a total loss of confidence in the architects of the system. This isn't about inflation ticking up a few percentage points. This is about a silent vote of no confidence in the US dollar, the euro, and the British pound. The wealthy families, the private offices in Zurich and Singapore, and the central banks in the East are not buying gold because they want to get rich. They are buying gold because they are terrified of staying in a fiat currency that is being weaponized by geopolitics and diluted by incompetence. They are looking at the leadership in the West, at the mounting debt piles, and the erratic foreign policy, and they are effectively shorting the competence of Western governments. This loss of confidence didn't happen overnight. It is the result of a decade of catastrophic policy errors, particularly in the energy sector. You cannot have a strong currency if you do not have a strong economy, and you cannot have a strong economy if you destroy your own energy security. Look at the example of Germany, once the industrial engine of Europe, the powerhouse that held the Eurozone together. In a knee-jerk reaction to the Fukushima disaster in Japan, a disaster caused by a tsunami in a seismically active zone, Germany decided to dismantle its nuclear energy infrastructure. This was a political decision, not an engineering one. They shut down reliable, cheap baseload power and replaced it with intermittent renewables and a heavy reliance on cheap gas from Russia. It worked for a while until the geopolitics shifted. Now Germany is deindustrializing. Factories are closing, chemical plants are moving to China or the US, and the economy is stagnating. When you commit economic suicide like this, you destroy the backing of your currency. The euro is losing value not just because of money printing, but because the economic engine backing it has been sabotaged by its own politicians. This is why gold is hitting all-time highs in euros. It is the market's way of saying, we do not trust your ability to keep the lights on. But there is a deeper, more insidious manipulation happening that masks the true extent of this crisis. We need to talk about the bucket shop model of modern finance. To understand this, we have to go back to the early 1900s and look at a legendary trader named Jesse Livermore. Before he became a Wall Street titan, Livermore started trading in what were called bucket shops. These were gambling dens that looked like brokerage houses. You would go in and bet on the price of a stock, say US Steel. If the price went up, the house paid you. If it went down, you paid the house. But here's the catch. You never actually bought the stock. No share of U.S. Steel ever changed hands. It was a pure side bet, a derivative transaction completely detached from the real company. Today, the Western precious metals markets, the COMEX in New York and the LBMA in London, operate on a mechanism that is disturbingly similar to those old bucket shops. For decades, institutional investors have traded paper gold and paper silver. They buy a futures contract, hold it for a few weeks, and then roll it over or settle in cash. They never touch the metal. They never want the metal. They just want the price exposure. This system worked beautifully for the banks because it allowed them to create an infinite supply of paper gold. If demand spiked, they didn't need to dig more gold out of the ground. They just printed more contracts. This diluted the price and kept the alarm bells from ringing. It suppressed the price of real money, making the fiat dollar look stronger than it actually was. But something is broken in this casino. The whales, the sovereign wealth funds and the central banks, have stopped playing the paper game. They have started demanding physical delivery. They are walking up to the cashier at the bucket shop and saying, "I don't want the cash settlement, I want the gold bars you promised me." And the bucket shop is running out of inventory. This brings us to the most critical signal in the global market today, the Shanghai premium. In a perfectly efficient global market, the price of an ounce of silver should be roughly the same in New York, London, and Shanghai, minus the cost of shipping. But that is not what we are seeing. We are seeing massive disconnects. At times, silver in Shanghai is traded for 10 to 16% more than the price in New York or London. This is an arbitrage opportunity that shouldn't exist. If you could buy silver in London for $25 and sell it in Shanghai for $29, you would do it all day long until the price is equalized. The fact that this gap persists tells us something terrifying. The metal isn't there. You can't buy enough physical silver in the West to ship it to the East to close the gap. The Western exchanges are being drained. The physical metal is migrating from the vaults of London and New York to the vaults of Shanghai and Mumbai, leaving behind nothing but paper promises and empty leases. This is the classic definition of a run on the bank, but instead of a line of people waiting to withdraw cash, it is a line of nations waiting to withdraw bullion. The shortage is real, and just like rent control destroys the supply of housing, price suppression destroys the supply of commodities. When you use paper derivatives to artificially hold the price of silver down below the cost of production, miners stop exploring. They stop building new mines. They high-grade their existing deposits, taking the easy stuff and leaving the rest. Years go by and suddenly you have a structural deficit. Demand is exploding from solar panels, electric vehicles, and military electronics, but the supply isn't there because the paper price lied to the producers for 20 years. We are now at the end game of that manipulation. The exchanges are starting to glitch. We see administrative errors, trading halts, and sudden rule changes. These are the tremors before the earthquake. So how does this reset actually happen? How does the system transition from a failing paper reality to a hard asset reality? Marioinnecco suggests there are two ways this plays out. The first is the dramatic Hollywood-style overnight reset. This is the scenario where you wake up on a Monday morning to find the banks closed for a holiday. The G7 leaders announce a new monetary framework. Maybe they devalue the dollar by 50% overnight against gold. Maybe they introduce a new digital currency backed by a basket of commodities. In this scenario, if you are holding cash, you lose half your purchasing power instantly. If you are holding paper derivatives, they might be settled at the old rate or simply canceled under force majeure. Only those holding the physical asset outside the system preserve their wealth. This has happened before. In 1933, Franklin D. Roosevelt confiscated gold and then revalued it from $20 to $35 an ounce. A massive devaluation of the dollar that stole purchasing power from savers to bail out the government. But there is a second, more likely scenario that is already happening right now: the boiling frog. This is the gradual, agonizing reset where the authorities don't announce a collapse. They just let inflation run hot while suppressing interest rates below the real rate of inflation. They gaslight the public. They tell you inflation is transitory. Then they tell you it's peaking. Then they tell you it's a good thing because it helps reduce the debt burden. Meanwhile, the price of gold and silver climbs steadily in every currency on Earth. It's not an explosion, it's a relentless grind. Your grocery bill goes up 20%. Your insurance doubles. Your rent skyrockets. You are earning the same number of dollars, but your life is shrinking. This is a default in slow motion. The government is defaulting on its promises to you, not by refusing to pay, but by paying you in currency that buys less and less. In this scenario, the reset isn't a single event. It is a decade-long period of wealth transfer from the middle class to the asset holders. The danger of the boiling frog scenario is that it lulls you into inaction. You keep waiting for the crash, not realizing that the crash is happening every time you go to the supermarket. You keep waiting for the signal to buy gold, not realizing that the price has already doubled while you were waiting for a pullback. This strategy relies on management of perception, or MOPE. Central bankers know they cannot fix the math. The debt is too high, the deficits are too large. So their entire job is to manage your psychology. They use open-mouth operations, speeches, press conferences, and careful leaks to make you believe they are in control. They pretend they can fight inflation, but they know that if they raised interest rates to the level truly needed to kill inflation, they would bankrupt their own governments. So they lie. They extend and pretend. They delay the inevitable, hoping to kick the can down the road one more election cycle. But the road has run out. Since 2022, the bond market has revolted. Yields have spiked from near 0 to 4 or 5%. This sounds small, but in a world leveraged to the hilt, it is a seismic shift. The interest on the U.S. national debt is now crossing $1 trillion a year, more than the entire defense budget. This is a mathematical spiral that has no exit other than money printing. When the government has to print money just to pay the interest on the money it already printed, you are in the terminal phase of a currency. The risk-free return of government bonds has become return-free risk. And this is why the digital fence we spoke about previously is being constructed. As the currency fails, the government will become desperate to trap capital within the system. This brings us to the question of confiscation and control. Many people hesitate to buy precious metals because they are afraid the government will simply seize them, like they did in 1933. But as Mario points out, the government has evolved. They don't need to send agents to your door to take your gold coins. That is messy, optically bad, and difficult to enforce. Instead, they use the modern tools of financial repression, taxation, and digital friction. They will likely implement windfall profits taxes or unrealized capital gains taxes. They will make it difficult to sell your metal without incurring a massive penalty. They might launch a central bank digital currency, CBDC, and say that you cannot use these digital tokens to buy unapproved assets like gold or crypto. They don't need to confiscate your wealth if they can simply render it immobile. However, this is not a reason to avoid precious metals. It is the exact reason you must own them. The threat of capital controls is the signal that you need assets that exist outside the banking ledger. If you hold physical gold and silver, you are holding the only financial asset that is not simultaneously someone else's liability. A stock is a claim on a company's earnings. A bond is a claim on a government's tax revenues. A bank deposit is a loan you have made to a bank. All of these rely on counterparty performance. Gold relies on nothing, it simply is. In a world where every counterparty is suspect, where banks are insolvent and governments are bankrupt, the asset with no counterparty risk is king. So what is the growth grid action plan in the face of this silent reset? First, you must recognize that business as usual is over. The 60-40 portfolio of stocks and bonds is dead because bonds can no longer protect you in an inflationary default. You need to position yourself like a central bank. Look at what they do, not what they say. They are buying gold. They are repatriating their reserves. They are preparing for a world where the dollar is just one of many currencies, not the undisputed hegemon. You should do the same. This means allocating a meaningful percentage of your net worth to physical precious metals, not the paper ETF, SLV, or GLD, but the real metal that you can hold in your hand. Second, you need to think about jurisdiction. If you are in Europe or the US, you are in the heart of the debt crisis. Diversification isn't just about buying different stocks, it's about political diversification. Holding some assets outside of the immediate reach of your home government, whether that is in a private vault in Singapore or Switzerland, or simply in self-custody where it doesn't appear on a bank balance sheet, is essential insurance. The text mentions the concept of unrealized capital gains tax being floated in the Netherlands and the US. This is wealth confiscation by another name. You need assets that are invisible to the automated dragnet of the digital state. Third, you need to prepare for the, quote, parallel economy. Mario describes a scenario where commerce happens peer-to-peer. I have an ounce of gold. Do you have the service I need? This sounds primitive, but in a breakdown of the banking system or a digital lockout, it is the ultimate freedom. Building relationships with local producers, understanding the value of real goods, and having silver coins, which are perfect for smaller daily transactions, gives you the ability to transact when the card readers go down or when your digital wallet is frozen for suspicious activity. Finally, you must adjust your mindset from investing for profit to investing for survival. We are conditioned to look for the highest yield, the fastest return. But in a reset, the goal is purchasing power preservation. If gold goes to $10,000 an ounce, but a loaf of bread costs $50, you haven't made a profit, you have just survived. The person who held cash has lost everything. The person who held gold has kept their place in line. This is the distinction that matters. The fear trade is about ensuring that when the dust settles and the new currency is introduced, you still have a seat at the table. The warning signs are flashing red. The arbitrage gap in Shanghai, the breakdown of the bond market, the desperation of Western energy policy, and the rush of central banks into physical gold. These are not random events. They are the synchronized movements of a system preparing for a collision. The boiling frog is getting hotter, and the water is starting to bubble. Do not wait for the official announcement on the news.